Welcome back to the Economics of Real Estate. I'm Dylan Silbernagel. There's my partner, Matthew Gizzie. We are here today to talk about that rate change that happened last week and what it means for the housing market. Is this going to be the match that starts to bring buyers back to the market? Are we going to see showings pick up? Matt, you've put in a lot of work today to start analyzing what's going on in terms of other policy changes, what we typically see with these rate cuts, to kind of break down, because it's been a little while now since we've had one of these cuts, and that the forecast for that keeps fluctuating. Are we going to see more? Are we going to see less? What does that look like? And obviously this year of 2025, it has not been the year for real estate in terms of the rebound that it looked like we were going to see coming through the fall of 2024. So it's important that we're taking the time to look at all these leading indicators so that we can give people the best piece of advice that they need, and sellers can, and buyers as well, can take advantage of opportunities out there. But first, buddy, before we get into that, how you doing today?
Good. I'm doing a lot better. Had a tooth removed, got an infection, got some vertigo, all straightened out now. So excited to get into the data this week, because it's extremely important that we comb over all this information and be able to try our best to try and map out, what direction are we going to be heading in over the next couple months, 6 months, 12 months.
Yeah, I think that's what's on everybody's mind, right? Is where are we going from here, right? And the the biggest thing that I can say, I think 2025, I was going to sum it up into a word, has really been uncertainty. That uncertainty has probably been the biggest factor in terms of what's impacting our housing market, because like we've said numerous times on this show, we sold more houses last year at higher interest rates and at higher prices. Prices have come down. Interest rates for, Bank of Canada rates anyway, have come down. Fixed, we're still seeing fluctuations there. So those things have come down, and you'd think that if you're just looking at those two factors, housing market should be doing better. And that's just not the case. That's why you've put all this time in to give us more information, more context as to what's going on. So without further ado, let's jump into it. And let me just get my slide deck going over here. There we go. So perfect. Matt, why don't you run us through some of the key highlights? And I like what you've added on here is, what didn't they say in their press conference with that announcement? What was omitted? So why don't you start us off at the top here with what the highlights are?
Yeah, absolutely. So policy rate cut was 25 basis points for the overnight rate. So it's dropped down to 2.5%. And like you were mentioning before, this is the first cut that we've seen in 6 months. So we've been extremely stable. A lot of that has to do with inflation. They wanted to kind of see where that was heading. But the labor market has weakened. We're up to 7.1%. I think the average forecast for where we're going to ultimately end up there is 7.3 to 7.5. Could be less, could be more, but that's kind of where economists are expecting it. When it comes to inflation, the CPI is cooled. It's down to 1.9 on the core. On the headline CPI, but core is still high at 3. People have to understand too, we've taken out the carbon tax. So that is going to drive down the headline CPI to a cooler position than where it was before. So it was inflation. Who would have thought of that? So the one concern for me is that core inflation is still high. If this continues to tick up, it's going to potentially cause a pause. But if unemployment and the GDP, which has been contracting down to 1.5 to 1.6, if inflation starts to run away again, then that's definitely going to be a headwind. And then when it comes to trade tariff risk, we've removed a lot of the counter tariffs that we had on the US. Those are inflationary because it's Canadians that are paying that tariff ultimately to the US products that are coming across the border. So that's been removed for the main reason that if they didn't remove that, inflation would be much higher, which would also not allow them to bring the interest rate down potentially to where they need it. And what's critical about these press conferences is the Bank of Canada is going to tell you where they're heading. They're very careful about what they say during these press conferences, because if they mislead, it will it will drive people to potentially do the wrong thing because they think that's what the Bank of Canada is going to do. So what did they not say during the press conference? And there was no commitment for a multi-cut cycle, meaning they're not saying that for sure they're going to cut next month or the month after. History will tell us that when usually comes one rate cut, another one follows. This would be unprecedented if only one rate cut happened in this particular cycle that we're in. But they also didn't, they didn't say it. They didn't want people rushing out and getting ahead of themselves either because of where inflation's at. They didn't claim inflation immediately was overshooting. The focus more on inflation being under control rather than accelerating. Again, depending on what happens in the world, that there still could be a potential for an acceleration in inflation. And then no recession forecast, even though there is some contraction weaknessing in the labor market and in the GDP. So there are areas of concern, but they didn't mention that. They didn't bring it up. So that was interesting to hear. And then as far as the tone, were they dovish or hawkish? It seemed dovish to me. A rate cut plus a shift towards, the potential for economic weakness, meaning that more rate cuts were going to potentially have to come. But they're still cautious. They stressed uncertainty, and we're going to have to watch the data on a monthly basis. We're going to have to see how the jobs come in, how the inflation comes in, how the GDP comes in, because that ultimately is going to dictate what the Bank of Canada is going to do, in my opinion.
Yeah, I think throughout the year, they have been pretty non-committal to what's coming up next in terms of those cuts. They're constant. Like at the beginning of the year, is like we're monitoring inflation. If we need to slow this down, we will. If we can continue on, we will. We're just gonna watch, right? I think that non-committal aspect has been there, and for those of you that haven't seen it yet, we did a video last week where we had Nicole Ferrugia from Mortgage Ease on with us to do a deeper dive on what these rate cuts meant, what we're seeing actually in her market, what some of the leading indicators are that she's seen as well. So please check out our YouTube channel to go get that at a deeper dive, because we did the same, Matt. We took a longer look there at the unemployment numbers as well. So please go back and check out that video. It'll give you a little bit more insight if this is something you're looking to understand a little bit more. And the big takeaway for me there is it would be a little unprecedented to not get another cut coming up in the cycle. Yet at the same point, they are watching those unemployment and inflation numbers still before they decide what they're going to do. And they are being a little bit more cautious, perhaps, than they were previously.
Yep.
Yeah. Awesome. All right. Well, let's take a look. Now, talk to me a little bit about some of these trade fears and what historically is following, especially after cuts like this, and what other aspects of the economy may it impact?
Yeah, so Better Dwelling came out, did an article. It's always good to look back and see what's happened in prior cuts. What are some similarities that are going on? What can we maybe see that happened in the past that could potentially happen in our future? And so Better Dwelling ran this article, and we just kind of took some of the takeaways that we thought were important from that article. So what history says. So in the past, on external demand shock. So in 2015, there was an oil demand shock. 2008, 2009, the mid 90s, which we saw, housing issues, the dot-com bubbles. Rates helped, but the business investment recovery lagged. So we are starting to see weakness in the jobs market, weakness in the business. But what the past has told us is that with these rate cuts, it takes time. It takes time to get through the economy, get that investment back. Maybe you need to build things to build out your business. Well, that takes time to build. It takes time to get the approvals. So before the economy starts to feel the impacts of these cheaper rates, it does take some time. Now, cheap credit tends to flow into real estate and asset inflation. So when you have it's easier to borrow money and dump it into maybe the stock market or cryptocurrencies or gold than it is to take that money and build a property, build a business, because those things just take a lot of time. Whereas you can put that money directly into the stock market, directly in crypto when the rates come down, and start to drive asset prices to the higher side right away. So it is possible with these rate cuts coming up, and what appears to be a bazooka of money coming from governments around the world. We could definitely see real estate and asset inflation. I think real estate will take more time, just because people use these as their homes and they need to make sense on their day to day that they can afford these properties. And then what we saw was recovery was uneven and slow. So again, you saw a bunch of money flow into hard assets. When it came to the job side, it took more time for that to get in there.
Yeah.
So what?
And while we stay real quick, while we stay on the history side of things, we had taken a look at something like this previously when the rates cuts first started to happen. We're like, okay, well, what happened the last time these cuts happened? What did we see in terms of the impact in the housing market? And like you said, we see that lag in recovery. Now, here we're talking about the business recovery, but we saw that lag in prices. We actually saw prices continue to decline as the cuts would happen. And sure enough, like that's what we saw historically, and that's what we saw this time around. We've seen
Yeah.
prices continue to come down even though these cuts are happening because it's that lag of all that money coming back into the really ultimately getting back to the consumer way down the line.
And also too, the jobs market is worsening. We're seeing more unemployed people, and a consumer needs confidence that they're going to have a job
Yeah.
before they decide. So when the whole tariff thing happened, there was a lot of fear that, okay, wait, before I make this huge commitment in real estate, I want to make sure that the business I'm in and everything is good to go. Now there have been sectors, but I've talked to a lot of people that have businesses that are part of the trade agreement that we have with USA and Mexico, and they're telling me, we've seen no complications, no interruptions, nothing along that sort. We're not
Mhm.
paying any tariffs. So a lot of businesses are a lot more comfortable now knowing that. Now we will have that big negotiation with the U.S. and Mexico coming very shortly into the next year. So that is something to keep an eye on. But as far as what's happened with the tariffs, I believe only 15% of the trade between countries is being affected by that, and it seems to be more on the automotive, steel, aluminum, lumber side
Mhm.
than a lot of other areas.
Yeah. And it's interesting, like you say, now when we're looking at as we move on to what's the difference, this is coming down to tariff and policy driven. It's not an issue of a commodity collapse or a currency crisis. Though I was just away on vacation, and I can tell you that our dollar is in fact horrible.
Horrible.
But but nonetheless, that's why we're watching this, right? We're watching. It's more of a policy challenge that we're facing at the moment, and like you said, it was mostly uncertainty that's kind of been impacting people because even some of these sectors now, nothing has really changed, but it's hard to make plans when all of this stuff is up in the air. So we don't know, should I be hiring more? Should I be rolling back? Should I start cutting jobs now so that I don't have this overhead going forward, because I can't wait to react when I'm already in too deep. So I think that uncertainty, like you were talking about, is really the biggest challenge that we've got.
Yeah, and I mean, Better Dwellings highlighted that the current trade disruption is tariff, is policy driven, and not a commodity collapse or a collapse or a currency crisis. So, we're very much an oil based economy. Our dollar is tied to oil as well. So when oil takes a big hit, Canada feels that because we do export a ton of oil, a ton of natural gas, a ton of resources uh, out into the world. And when countries like China or the U.S. are not buying commodities, it can have a big effect on our economy as a whole. So we're not facing a commodity crisis. I think we're actually going to have quite the commodity boom coming in the next 10 years over that stretch. And it's imperative that Canada is taking advantage of this boom that's ultimately going to happen. We can see the governments are all coming out. We're going to make generational investments that haven't been seen since World War II, since after World War II, when we were trying to rebuild economies and get all that out. So, like, they are advertising to us that there is something big coming. There's going to be a lot of money coming into the system to try and build this country out. For the last 10 years, we've been trying to suppress that with the last regime that was in. And now it seems like they've finally gotten the message and said, hey, we need to build this out. We can't rely solely on just the US to buy our commodities. We need to try and get at least some of it out into the world to at least help lift the prices of our commodities. So when I see this tariff policy driven, okay, 15% is having an impact on here. I think the terrible investment that Canada has done in our resource economy over the last 10 years is what's starting to show up. You know, people were screaming from the hilltop saying, hey, this is going to hurt us at some point. Well, it's hurting us now. You can't fully blame Donald Trump and his tariffs. It is hurting some sectors, yes. But 85% of our trade with the biggest trading partner in the world that everybody tries to line up and trade with are still doing business as normal. Nothing has changed. So I think this is more of a factor of, hey, we didn't spend enough money building out the systems that we need to be a profitable country. And we're seeing that in our GDP numbers. We're seeing that in our productivity numbers. So hopefully we're finally in a position now where we're going to start to adjust and take advantage of that. But with the Liberal Party, you never know. I guess we'll find out in the budget where all that money is going to ultimately go.
Mm-hmm. Now, before we get to risks and takeaways, I have a question for you because the third point that Better Dwelling brought up was saying that the Bank of Canada is more reactive now when they see damage in exports, business investment, the labor market. So they're saying less lead time to those changes. Does that feel accurate to you? Like, has that come around now? Because I feel like, yes, we were higher for longer, but it wasn't that they didn't see the damage to the export. It wasn't that they needed to really combat inflation, which we've been hitting the nail on the head like over and over again here. Do you feel like they're being more reactive now or no? Just personally.
I feel like I feel like the amount of debt in the system is what's really triggering these changes. I think they're looking at, okay, we've got 60% of all people that need to refinance their mortgage over the next year and a half. If the US is going to cut, we're going to sneak under there and cut as well. Because maybe it's not going to impact our money or our dollar or our trade as much because the US has cut as well. I think businesses are heavily indebted because of what happened during COVID, the amount of money that small businesses, even large businesses, had to take on to get through that time. And then going to the federal governments, the provincial governments that took on insane amounts of debt that are all coming due now over the next year and a half. And the central bank is having to get ahead of that. I think
Mm-hmm.
ultimately that's what it is. And then at the same time, if the governments are going to come out with this spending incentive to get us going again, that's going to incur debt, unbelievable amount of debt, and you need rates to be low enough because you only bring in so much tax dollars. You probably can't tax the citizens anymore, so the only thing you can do is try and get those rates down a little bit further. So I think they're going to run the economy hot uh, because ultimately, if you devalue the currency, it makes it easier in the future to pay off the old debt. Um, so I think I've answered your question there. I think that's
Yeah.
kind of what your gist was.
Yeah. No, you did great. You did great. And I think before we wrap up this slide and we just talk a little bit about those kind of the risks and the takeaways, because I know we've hit on the risks a little bit here, but um, the big one for me that I think people need to know is that these rate cuts alone are not going to restore investment. It's not going to magically fix the economy. It's not magically bringing buyers back to the market, like we've said a bunch of times here. Um, but going back to to the monetary policy, like we've talked before, we need more policy changes to really right the ship. But there's more lag there with that, right? And the big point that they mentioned here in Better Dwelling is by the time those effects do show up, we may be in a worse spot if we're relying solely on those policy changes. So I think it has to be a combination of the two, but you can't bank on, okay, a cut has happened. We're now in a better spot.
Mhm. And I like the risks and takeaways need for complementary policy tools, diplomacy,
Mm-hmm.
targeted supports, in addition to rate cuts. So, are we are we going to carbon tax everything? Are we going to abolish fossil fuels in this country? Where are we going? Who are we? What are we doing? And I feel like that's not out there enough. I feel like there's too much complication about what Canada is and is not, and what we're going to do for business going in the future. Why would I invest money somewhere, especially in a commodity based investment, if I don't know where my government stands on are we going to sell the world more oil? Are we going to sell the world more natural gas? What is our stance on there? Are you going to tax me to death on the carbon that is produced in my business? We don't know that. And the U.S. is coming out and saying we're not going to. We don't have that. Come to us. Do business with us. So I think Canada needs to tell the world, especially on the investment side, hey, we're open for business. These are the rules. These are the policies. This is how we're going to help you. Come over and let's do business. And I'm not seeing that. And Mark Carney came in promising this type of stuff. And you can say what you want about Donald Trump, but he went into that. He came out guns blazing to try and get that economy going. So far, so good. Stock market's at all time highs. Their labor market is at 4% for unemployment, whereas we're at 7. So, we need more out of Mark Carney to come out here and say, hey, listen, Canada's open for business.
Mm-hmm.
Let's get going.
Yeah. We need some improvement on that scorecard, especially when you look at the
We do.
two. Yeah. All right. So let's talk about some of the household debt challenges that we're facing because again, at the end of the day, if we are getting pummeled with debt, it's hard to see our housing market turn around, right? And we had this conversation with Nicole as well, talking about, okay, when refis are happening or when purchases are happening, how much debt is getting rolled into these refis? And I want to say, actually, I don't even want to say, go watch the video on what she said, how much she was seeing kind of on average was getting rolled in debt wise, because this is an important thing to notice. And like we talked about, why we wanted Nicole on the show, that's something that us as realtors don't get to see all the time. That is something that remains private between you and your financial advisor, your mortgage broker in this part. Are you refinancing some debt to get off those higher interest rates like we're seeing on credit cards and stuff like that? And that will impact how much people are willing, comfortable to make that next move, to make that next move up, or if they need to downsize because of that debt. So this is a very important factor that we need to be watching. And frankly, Canada has not been doing great in this department when we look at how much household debt we've been growing. So I want, before we start pulling into the charts, talk to me a little bit about what's going on in regards to household debt there.
Yeah. So household debt to income ratio is at 174.9%. And we've seen 3 consecutive quarterly climbs. So what this basically means, for every dollar you make, the average Canadian owes $1.75 basically in debt. So we've seen this number really. If you look back at the 1990s, we were you made a dollar, you owed a dollar. It was, or actually, it was significantly less than that.
Mm-hmm.
Uh, but what ultimately happened is, and I've talked about this before, is the world changed after 2008. We got super low interest rates. Now we live in a debt-based society. If you want to get ahead, unfortunately you have to take on debt. Not everybody, but the average individual has to take that debt. If you want to buy a house for you and your family, you're going to need debt. Most people don't have money just to buy a car. You have to take debt on for that. Unfortunately, with the interest rates as high as they are, we're seeing a lot of people paying their mortgage with their credit cards, paying their day-to-day life with their credit cards. So, you know, debt is growing 3 times faster than income right
That's
now.
the big one that I think people need to be mindful of, is that
And
stat
it's
right there.
super alarming. It's super alarming. Because what that is telling me is that, the cost of living is getting so out of hand, and their incomes are not keeping pace with the inflation that we're seeing. unfortunately, this chart will never, I don't think this changes. I don't think this train stops. I think this just continues to get wider and wider and wider, because unfortunately, the money system is now broken. It's only going, you're going to need inflation to pay off these old debts. You're just going to need it more and more and more. It's not uncommon to look around the world and you say $1 gets you $1,000 of this other currency, right? And we're starting to see that where people see the inflation. They see like $1,000 doesn't seem like a hell of a lot anymore.
Yeah.
You can't even get someone over to paint a bedroom and fix up some walls. It's like it's incredibly insane. So we are starting to see this divide here, and um, and if we look down at the bottom here at household debt in the G7, we are the highest. We
Yeah.
are the highest. And we've stagnated, but we've stagnated because we've brought in an incredible amount of people into this country who don't have a lot of debt, who are going into jobs, they're making income. So the income side is rising. It's showing that it's rising. Um, but these people don't have a ton of debt because they're new to the society, they're new to the working. So the spread seems like, hey, it's not that bad, it's getting okay. Well, those people ultimately are going to start taking on debt because the only way to live in this society, especially if you're just starting out, is to
Mhm.
try and accumulate some debt. So what worries me the most is that debt is going to maybe even grow faster than the 3x that we're seeing now once these couple million people that we've brought into the country start to accumulate, start to buy real estate, start to buy cars, and start to rack up the credit card debts, the line of credit.
Yeah, and when I look down here, let me just go back. When I look down here, some of our lowest guys that percentage wise, they're even under the 100% there. You've got Italy, you've got Germany, the US there is probably just above the 100% mark. And so it's interesting to see, like, I don't know. It's disheartening to see how much higher we are, like hovering at that 175, just like we talked about in our upper stats here. And we're just so clearly having a struggle with this, like nationwide, carrying way too much household debt. And if we slide over to the next slide and we're looking at income and just how we've pulled away from that. So here's our debt, the way it's been climbing. Here's our income, and this is it outpacing it at 3x, right? And so, you know, how do we bring that back? Does it come back? I think it was interesting, like you said, we have seen a little uptick there in terms of the disposable income just at the end of last year, coming into Q2 there, and it makes so much sense when you talk about the amount of people that we brought into the country that don't have that debt registered here as of yet, right? So
Yeah.
I think that it's disheartening that we see a lot of these guys rolling kind of over in this scenario, and we have rolled over a little bit, but we also have brought in more people than any of these other countries, and that's going to be part of our challenge. It's not showing the full picture even still, and it's not a great picture.
It's not a great picture. And, I'm not trying to blame immigrants whatsoever.
No.
So to be clear on that, but what the government kind of did during the pandemic was, holy smokes, we got to borrow all this money to make sure that the economy is not going to collapse. But we also don't want to lose our credit rating, so we need to keep GDP at a certain level, because if debt to GDP on the government side falls too much, you could potentially affect your credit rating, which ultimately means you need to pay higher interest rates. So how do you keep that GDP? Well, you bring a lot of people into the country so that the transactions are happening more and more and more, so it keeps it nice and strong. Because we did get a little notch in our belt when it came to the credit rating, which ultimately meant that Canada was paying more on the interest rate side. So they had to keep it strong. We saw it all over the Western economies. We saw immigration levels all over the place stay extremely high. Even in the U.S., the southern border wasn't kind of walled off. It was open for a reason. It's because they needed GDPs to stay high so that their borrowing costs weren't affected to a degree. It's not the entire thing around that, but that's kind of why we did see such a big spike in
Mhm.
immigration, was I think the government GDP as well.
Yeah. So I think it's important to note, like when you're taking a look at the housing market, this is still a concern that we have going forward is the amount of household debt that Canadians are taking on. All right.
But interesting too, I want to go back
Yeah.
because outside of the GTA, outside of Southern Ontario, real estate's actually doing quite well.
Mhm.
Um, and it's just what we've seen. We got way too over leveraged in the GTA. We're seeing that pullback happen, but these interest rate cuts are going to help Ottawa. They're going to help a lot of these cities that didn't get crazy run ups during 2021, 2022. So these rate cuts are going to help those outlier areas. I just think that we've still got a little bit more pullback because of the amounts of debt that have been accumulated in the cores um, before we start seeing acceleration
Yeah.
for prices.
Yeah. Well, and then we also have to take a look at how much housing prices did accelerate in those core metropolis areas, right? Metropolitan areas, because those increases were also unsustainable, right? And so
Yeah.
I think that it's all relevant there. All right, this is a big one because despite the market being slow, sales volume being down, all the reports are still saying that we are going to have a housing supply shortage. Like with the amount of people that we have just in the country in general, whether it's been people that have been brought in, just our population in general, our real challenge has been the rate at which we are building homes. We just do not have enough homes for everybody, which was part of the challenge with the supply and demand, why prices went up as much as they did. And even though we're in a spot right now where everybody's putting their foot on the brake, this isn't an issue that has gone away. And so it's important for us to continue to monitor that. And this is something that Carney came in talking about as part of his platform to get elected. And so, Matt, why don't you talk to me a little bit about not just what Build Canada Homes is now, but what we had before and kind of what, I guess, maybe a little bit of what the differences are, positive and negatives from it. And is this something that will make a difference?
Yeah. So there's the BCH, which is the Build Canada Homes, which is what the government's come out. Now let's remember too, governments always say that they're going to build more housing. It doesn't matter what party. They all say they're going to build more housing, and time again, they always let us down, unfortunately. Because again, governments are terrible at investing your money. Number one. Number two, we used to have a program back in the day called MERB, which was the multi-unit residential building fund. So it had a lot of doctors, lawyers, dentists, people that had a lot of capital were able to invest that capital into multifamily type properties. And then they got tax breaks for that. So, okay, they got a tax break, but also we were building housing and we built a lot of housing. From 1974 to 1982, we built between 170 to 195,000 rental units. Now, that was back in the 70s. I think if that program was running today, we'd be able to build a lot more. The government's coming out and telling us, hey, we're going to spend $13 billion of your money to build 4,000 units that aren't homes you can own. They will be rental properties on government lands. They won't be location specific. They might be in bad locations. They might be in outer locations. You don't know that, right? And also $13 billion for 4,000 units. That math is a little bit odd to me. It seems more like, I believe that's what, $3 million, $3.2 million per unit. And this is the problem. You get governments into building homes, and it seems like a great idea, but unfortunately, it's not. They're just terrible managers. And when you go to the people in the economy, like doctors, like lawyers, like other dentists, people that make great incomes, who don't want to pay 50% tax after that $100,000 that they've made, why not recycle that money to actually build houses, which we've seen in the past work? History will tell you whether it will work. History has told us that governments building us properties, for the most part, does not work. History tells us that when you incentivize people, investors to build, they will build. I see this from the government. I don't believe it. I don't believe it because they never follow through on their promises, unfortunately. So, you know what? If their program works and we do get another 4,000 rentals, that's fantastic. It'll definitely help lower income individuals with a place, but we should also be putting the MERB back on the table and
Yeah.
allowing individuals in our society to get a little bit of a tax break on their money to also build more housing. Because when you get a massive influx of housing, what does it do? It keeps housing prices stable. Okay, that's a form of affordable housing as well, because when there's more homes on the market than what people need, there will be a portion of homes that become very affordable in certain neighborhoods. So what we need right now is a ton of properties to hit the market. I think that they should be bringing back the MERB program. I think Carney's been talking about the potential of doing both these different um, systems. So I
Hmm.
hope he does go through with it, because we do need more and more and more and more housing. But at the end of the day, if you just rely on government to build housing, you'll never get enough, unfortunately.
Yeah, I did some quick math there, and looking at 3,250,000 per house for those 4,000 units. Now I know the programs is facilitating other factors in there as well, but when you're just looking at the information that they're putting out for the amount of units we're going to get back from it, yeah, the numbers are way off. And
Yeah, and I get like the negatives here. Become
yeah,
a tax shelter for higher income earners.
yeah,
Like, I understand there's a portion of the population that's not going to want to hear that, but at the same time, if this can drive a massive amount of housing, like we saw that it did back in the 70s and early 80s,
hmm,
there are trade-offs for this. If you can get a house for a lot cheaper, or you can rent a property for a significantly cheaper amount of money, and you're not having to worry about your landlord raising your rent 10, 20, 30, 40, 50, 100% every year, because
yeah.
there's too much demand. There's benefits for them as well.
Yeah, and let's take a look at that. The 170,000 units to 195,000 units over the span of 8 years. Again, even if you take the low number there and you divide it by eight, you're getting 21,000 units being built, 21,250. So, again, we're not even talking about impressive numbers with the Build Canada Homes program like we saw with MERB. So, um, I think the two pronged approach just makes sense. But like you said, I'm uncomfortable with the government getting into being on the building side because their investments don't work great. And even just looking at those numbers on face value, we're way off in terms of what you'd think this program would cost, or at least the results that it would deliver.
Yeah.
They're not putting forward a rosy colored image by any means in terms of like, look, we're going to spend little and get you a lot. No, it's like we're going to spend a ton and we're going to get you 4,000 units. So
Yeah.
it's something that we'll have to just kind of keep talking about going forward. But it
That's
doesn't
it.
sound like it's going to be the solution for us by any means.
Yeah.
All right. Okay. Next, I mean, perfect. We're talking about rental supply gap and the fact
To
that it's going
double, to double in the next
yeah.
10 years. And this
Don't
is
worry,
from
don't worry, Matt. We got 4,000 units coming sometime. I don't know when versus our usual 20,000 per year like we used to get. Um, yeah, no, it's all good. This is not a problem at all. As we still see people carrying on more debt, maybe less likely in those scenarios to own a home. We're gonna need a strong rental market, and our supply gap is doubling in the next 10 years.
it's so important that we have a strong uh, rental market, because young people need to get into an affordable rental property so that they can save money to make that next step in their life. But what the society that we're in right now is that a young person jumps right into a rental at an insanely high price because of the amount of demand, and it's almost impossible for them to save up anything. So either their parents are giving them the down payment on the house so that they can transition to that, um, but in the past, you would rent a place for maybe 5, 10 years. You and your partner would pool your money together to have a down payment on a property. And that can't happen right now because there's far too much demand. Rent prices are insanely high. Um, and this goes to say why we need another 232, or sorry, we're going to have another 232,000 new renters over the households over the
Mm.
next 10 years. So we are going to be in a deficit of 121,000 units. So if you're a young person and you want to own a home so that you can raise your family there, the 4,000 homes that the government's going to build is just not going to cut it. You need private investment to build this stuff. And in my opinion, what stalled this out, what absolutely hammered the rental market in Ontario, was that they put rental controls on the places. This seems like a great idea. You can't raise my rent. How, like, just look, the proof is there that rental prices have gone through the roof because we just don't have enough rentals in this province. If you leave rent caps alone, they will overbuild, which means prices of rents will stabilize. They can't just jack up your rent every year because they've overbuilt. That's the way I see it. As an investor, oh, I can't raise rents ever. Okay, I'll go and build apartment buildings somewhere else. Once Doug Ford came in and changed that rule, the amount of apartment buildings we're building now is significantly higher. They represent over 50% of all new starts in Ontario are rental properties. And we want that to continue to accelerate. And the government needs to step in, incentivize the building some more so that we can do that, so that families can start again and be able to rent for a little while, save up their money, and buy the house that they want to ultimately live in.
Yeah. And that's what we're seeing too, right? We're seeing that with the condo starts being down as much as they are because the condo market has its own issues. Fewer rentals are going to be there. Fewer investor rentals are going to be going out. When we look at some of that purpose-built rental growth, even what we talked about with the BCH and with MERB, it's the growth is just too slow. It's not going to keep up with the demand that we have coming in. And we still have that issue of affordability, right? And so if affordability is going to be a challenge, it's going to push people to the rental market. And if we don't have rentals available for them, it just makes a scenario where our population is living paycheck to paycheck, doesn't have enough housing. Housing is too expensive, both on the rental side and on the home ownership side. And it's not this great society that we've had historically in Canada. So these changes do need to happen. And I like how we kind of summarize it at the end there. Without that major policy change, BCH making a big change, MERB being in there, rents are going to stay under pressure and low vacancy rates, right? And so getting a place is hard. And here's what it looks like in terms of the reality of how renters then face this. You've got all these challenges over the last couple of years of we're seeing multiple offers when you're trying to get a rental. You're not guaranteed the place that you want to rent if you've got a good job, good credit, and good income. You're one of 15 that have that exact same scenario. So now what happens? Then we get into those like prepayment options of like, I'm going to give you the larger deposit. I'll pay 6 months up front. I'll pay a year up front. None of that is supposed to be happening, but it's renters almost taking it upon themselves to be like, I really need this home. And if I don't get this one, I don't know which one I'm going to get next. What can I do to ensure or at least better my chances that I can get this? And so as long as we have a supply gap, those practices will keep happening and those challenges will keep coming forward.
It's crazy it almost feels like it's deliberate, to be honest with you. Just because of how strong of a demand there. Typically with anything, when there is an extremely strong demand, you get massive competition to build what people want. It doesn't matter if it's housing, if it's a product, if it's a service. Higher prices are usually the cure for higher prices because the margins are higher. People want to get in and build that product. But it seems like people haven't been able to build the amount of products that the society and the client wants.
Yeah.
And something's getting in that way and has been getting in that way for a long time. And it needs to be pushed aside, out of the way responsibly, so that people can have affordable homes to live in. And we're not getting into markets all the time where prices are going sky high, then sky down, like crashing down.
Yeah.
We need a more stable, healthy market in this country, or in
Yeah.
at least Southern Ontario.
Yeah. And policy is going to be one of key drivers there.
Yes, absolutely.
Okay. Let's continue the conversation here on job losses. Obviously, unemployment ticking up. We've got some forecasts there on where we think it'll end, but currently sitting at 7.1. And like we said, no certainty in our jobs, no certainty in terms of buying a house. So talk to me a little bit about some of these key takeaways when it comes to the job losses we've been seeing, specifically these 66,000 jobs that we lost there in August.
Yeah, so this was an article again done by Better Dwelling. We were down 66,000 jobs lost in August, which was definitely not something we were expecting to be that high, and I do believe that that had an effect um, with the Bank of Canada cutting the rates. Unemployment up to 7.1 again. Forecasts have it at 7.3 to 7.5. So we still have some more pain in that area to come. And that's the highest since 2016 if we scrape out a
Yeah,
COVID.
COVID.
And then, the losses are broad based. So, we're seeing professional sectors, we're seeing a lot of sectors. So I know I spoke before that the automotive, steel, aluminum, lumber, they're seeing, but we're also seeing a stretch out as well. Like businesses are starting to contract a little bit because interest rates were so high for so long, and some consumers and some products, they are seeing, people are like, listen, I got my payments for my mortgage are 300, 400, $500 a month higher. That money's not going somewhere else now, it's going to the bank to pay the interest. So we're seeing other businesses start to suffer for that. Yes, rate cuts will help with that, but not for another 6 to 12 months, probably
Mhm.
12 months. So we have to think about that going out. So there's been the narrative of a soft landing. I'm still in the camp of potentially a soft landing here. And I know a lot of people might not agree with me with that. But again, I think the government's going to come out with a lot of money and try and build, 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 build. We'll see how efficient that is. Um, you know, it, Consumers and business confidence is weakening. Um, and it is, how does that change? Well, I think they've been fed this massive fear story from the US about the tariffs from Donald Trump. And people are out there thinking that 100% tariffs are on everything, but that's not the case. It's only at 85. So maybe confidence starts to come back up a little bit when interest rates come down and the government's spending more money. What really worries me is the youth unemployment in this country is skyrocketing right now. I don't have the data points to know, are they being pushed out? Are they just not interested in getting jobs at
Mhm.
their age? I don't know. I don't have a young person in my family that I can communicate that information with to see kind of what the data points are for why that's getting worse, but it's a very big cause for concern. These people are starting out in their lives and they can't even start with a job. They can't afford, you can't even afford a house, even if you have a job, but you don't even have a job. So that's extremely concerning to me. And that's something I hope our governments are going to focus on is making sure that the youth because if not, they're going to go somewhere else. They're going to
Yeah.
go to the US. They're going to go to other countries. They're going to go to other provinces to find jobs. And it's critically important that we get these numbers down more.
Yeah. Well said. Well said. Come back over here. Okay. The return to office mandates. And it's interesting because when we looked at how COVID happened at first, I think there was obviously a lot of fear on how our housing market, of course, would be impacted on this. And then it had kind of the opposite effect of what people would have thought. We saw a big run up in sales and of course prices. A lot of other factors came into there, but what we also saw was a mass exodus from the core areas out to more rural pockets and more suburbs, and we saw prices extend as we talk about like the big growth that we saw in Barrie and Georgina. And a lot of that people were able to do because they were able to work from home or they were only in the office 1 or 2 days a week, stuff like that. And now we're starting to see that flip back over and bringing people back into the office because that change also had a huge impact on commercial real estate, specifically office buildings, right? So there's a lot of different changes that happened and we're still adjusting to them. So Matt, walk me through a little bit on what's going on as we talk about the return to the office, specifically around Toronto.
Yeah. So, when the pandemic happened, Zoom became an extremely efficient tool, which allowed people to get work done outside of the office and not need to commute in. And I think at first a lot of businesses said, "Wow, this could save us an incredible amount of money. We don't potentially need these office spaces. Our we need to be competitive as well, and people that might want to work for us might not want to come to the office. We might have a better chance of getting better talent if we have this option of working from home. But I think the data is telling us that maybe that's not the case. Maybe employers want them back. Maybe employers can't get out of the contracts that they're in for the office spaces that they own, so they just need people to come back. But it has an impact on the outlying areas of Toronto or the GTA. Your Barries, your Keswicks, your Peterboroughs, because people were moving to those areas thinking that from now on I don't have to go back to the city. And we're seeing governments, banks, telecommunication companies, a lot of different companies are saying, no, you know what? You need to come back, even if it's only for 3 days a week.
Yeah.
We're starting to see that people might not want to even do 3 days a week of a commute. And prices have maybe contracted enough in the Toronto area where they're starting to think, hey, you know what? Maybe it is an option to start to move back into the city. So, this article is just highlighting that if we look at the top left chart here, we were, I don't know what percentage that is, 5-10% of people were commuting to the downtown, and now that's the amount of people downtown is up to 78%. So it is climbing to the significant side. We're seeing a lot of people go back there. And what kind of formation are we going to see happen in the housing market, in the family market? Are we going to see that pullback or not? So that's definitely something that we're keeping an eye on to see how that affects, definitely our areas, the Newmarket, Aurora, East Gwillimbury areas, how it affects the buyers. I actually was at an open house yesterday and I saw a lot of people still coming from Toronto in the Newmarket area looking to buy. So
Yeah.
might
We'll
not
see
be
if
as big of an impact as the charts are telling us as of today.
Yeah, we'll see if that direction change starts flowing back the other way. And I would say one of the positive sides of this is if we do see um, what would potentially come from this is that renewed demand in the condos, right? More people getting jobs down there, being like, okay, I'm going to live in the city. Can hopefully that, especially with prices, there's a lot of value in the condo market right now, provided you're buying the right unit in the right building. Prices have come
Yeah.
down so tremendously in that segment. And one of the biggest challenges that I see for the rest of our housing market is we've kind of cut out the bottom part of our funnel as people feed up through the housing market. You buy your starter condo, you gain some equity there, then you can buy your townhouse or your semi, and then the semi to your first detached, then your detached to your trophy home or whatever it might be. But with the condo market pricing being wiped down as much as it has, there's a real lack of equity there to help people take that next step going up. And so until those condo prices come back around, I think we will still have a fundamental challenge in our housing market rebounding because the bottom part of the funnel isn't trickling up anymore. So if we see this return into the condo market where we start to see some prices come back up again, I do think that there's a chance there that will overall help the rest of our market. So it will be interesting to see as we continue to watch this data, does this actually help our condo market? And I think at the moment, Matt, my hot take is that I don't think there's anything that can help our condo market right now. I feel like it is going to be a long haul to get the overall downtown core condo market back to where it was. There's been too many other policy changes. There's been too much of a shift, even just in how our society looks at things. The only saving grace there is they've really slowed down on building, which has its own other challenges. But at least we're not pumping in a ton more units into an already oversaturated market.
We're still finishing a lot, but that is going to wane out very soon. So there is more supply to hit the market, but you hit the nail on the head in regards to we've stopped building anything new. We've stopped selling anything new, which ultimately means in the future that there will be another issue with housing. We've slowed down immigration for now. We have a baby boomer population that's all starting to retire. So we need to infill all those individuals. So we are slowing down on immigration now, but it will hopefully uptick at a reasonable level, but it's still going to be a big enough level that we can't stop building right now. because we're just going to face another issue,
Down the
you
road.
know, in 28, 29, maybe even 27.
Yeah.
Um,
It's
but one
too
other, I'm going to blow this one up here a little
yeah.
bit more to kind of show that where Toronto, the average days in office per week, Toronto's currently at 2.7. But if we look prior to the pandemic, you know, we were up there at the four. And when
Mhm.
we look at some of the major cities around the world, we are tied with London as the lowest amount of people who are going back to the office right now. So we are seeing other places bring everybody back. What will happen with Canada? Will we start to crawl our way back up to the top? Will we just meet in the middle? Something's going to shift. We're not going to stay as low as what we've seen now.
Beautiful. Okay, so we led into this a little bit already, Matt, but talk to us about these housing starts collapsing. We're just not seeing more developments going on, and this is, of course, you know, it's in the condo market specifically. We're seeing it a little bit in the freehold stuff as well. So, talk to me about what's going on with the starts as we monitor. Really, we've got right now. We've got a couple issues. We've got a price and buyer demand challenge in the immediate, but in the long term to medium to long term, we have the challenge of not having enough supply.
Yeah, exactly. And this is what happens in boom and bust cycles is that, you know, this is what happens when you drive interest rates down to zero and then bring them up and then drive them down again. And it's just a yo-yo. It almost seems like we're never going to get out of this trajectory. And what we need is consistent building so that we're getting the amount of units that we need. But it doesn't make sense to build right now because the demand isn't there. But ultimately, the demand isn't there because you drove interest rates to insanely high levels that we haven't seen since 2008, 2009, with an economy that's different now. Like I said, the world changed in 2008 because of the great financial crisis. We became a debt-based society, clearly from that chart, which means you cannot just drive interest rates as high as they did. They did that to cool inflation. I get it. But now we're going to be in a situation where we can see starts are down 44% year over year. It's a 30-year low, lowest since 1996 when you adjust for population. Condo starts down 60%, mostly because investors, it doesn't make sense for them anymore. There's too much risk to put your money in something that you're not going to see a return on in potentially 3 to 5 years. And who knows where we're going to be. You know, hindsight says because of what's happening now, you're going to be in a better position if you buy now on a new build. But the cost of a new build is insanely high because of development charges, because of materials, because of labor. So maybe you only break even in the future. So you got to be. I think that's what investors are weighing there. And then since 2024, only 21 condo projects have been canceled. So more condo units have been canceled than what the government's going to build
Mm-hmm.
in new housing. You know, so had we not done this crazy, uh, you know, rate cuts and government spending and things were just a little bit more stable, those units would have already been in the market. So they're gone, and then
Without taxpayer money.
the government's going to spend $3 million. Okay, do you think would you spend $3.2 million on a condo? And the answer is no. You could get one for four, five, six, $700,000 depending on where your location is. But don't worry, the government's going to build you one for $3.2 million. You'll never own it; they'll rent it to you. So again, crazy. When it comes down to the rental market, you know, the rentals have started to slow 8%, not as bad as um, the condo starts, but there is a slowing down. We are seeing a little bit more rentals hit the market because we're seeing rental prices start to decrease. But again, I mean, the amount that we're building is starting to slow down, so we will start to see that in the future if we don't start to build up again. And then, kind of the national picture, Canada overall starts are near record highs outside of the GTA,
Yeah.
outside of Vancouver. We are actually building more just because the price points in those areas make sense.
Yeah, it's feasible now.
It's feasible.
Yeah.
And
No,
let's
I
not
agree.
forget, too, the municipalities came out with all these development charges that weren't as high as they were pre pandemic, pre like zero bound interest rates, so that they could soak up as much money as possible. And they need to scale those back significantly. The only question is, where are they going to get their money to help run the municipalities, because they can't take on debt, which ultimately, if they bring those back, are property taxes going to start to accelerate to the upside.
Yeah, and when we see that MPAC hasn't updated theirs still since 2016, we've missed two updates now. Really should have been 2020 and then 2024. Are we going to see those evaluations start coming in where people's home values are getting reassessed, so their taxes are getting reassessed now at much higher rates? And with honestly, with the amount of sales volume decreasing as much as it has, it is hard for municipalities to get money elsewhere, which is why the development fees, I think, have also been higher than they need to be, because that's how they get some of that money coming in. And so if they bring that down to like you said, if they bring that down to stimulate building, where's the money come from? And there's a good argument that we should really be watching what's going to happen with MPAC and our property taxes, because they're behind. They haven't done them, and they're going to be looking for another revenue source. At the end of the day, there's been a couple of reports that have come out saying Canada can't afford to continue on with some of the, let's say, assumptions of what always works in regards to our tax policy. They are going to need to make changes. They do need to find some of this money. We're talking about 13 billion going towards 4,000 units as the headline. Well, how are we going to get the money for that, right?
And that's it. And it's crazy to think that we're charging individuals who want to buy a home to start a family or start a life in this country, and they're paying 150 to $300,000 of the cost of that home for these municipality fees.
Mm-hmm.
And some of this needs to be spread out, I think, to, they're not the only ones that should be paying these massive chunks of money for the greater good of the entire town. It needs to be spread out a little bit more, like it was done in the past. I don't know how these municipality fees work or how they were implemented. So like, I don't want to, maybe I've been misquoting some of this. It's just kind of off the top of my head, this kind of what it feels like.
Yep.
But it feels like to me that they shifted raising everyone's property tax to just putting it all on anyone buying a new home, trying to take advantage of the market that we're in with zero bound interest rates. Because when you're zero bound and you're only paying 1.5 to 2%, it's easier to dump those fees on someone over a 30-year period than maybe it is in a market like today, which clearly is what's happening.
It may be an oversimplification, but you can't help but look at it and see the two correlation between the two, how one's kind of dropped off and the other one's really ramped up.
Yeah. I mean, if these development fees were 50 grand instead of 300,000, builders could be selling these for lower than what they are today. And maybe that's would help a little bit get people in the door for those developments.
All right, taking a look at our business barometer. So, Matt, talk to me here about what we're seeing in terms of small business confidence since our last update. And we're going to take a look at that 12-month and 3-month charts. What have you seen in comparison? And remind me, you've got the tail end there on the right for us. Was that from our last update where we were?
Yeah, so the chart on the right, which was last month, it was moving its way back up. At least the 3-month index was starting to get closer to its average at 49.3. It has rolled over down to 46.8. So there has been a little bit of confidence loss. This chart will fluctuate. So it's just the short term, but we're coming off extremely large lows that we saw at the beginning of the year when we went down to what appears to be 25.5 on the 12 month. And now we're sitting up at 47.8. So the small business confidence is not at the lows that we've seen prior. And this what gives a little bit of hope about small business. But again, going back to what I said earlier, small businesses also need to understand where we're headed as a country so that they can make those investments and feel confident that, okay, I'm going to make this investment because I know where we're going over the next 5 years. I know the return potentially that I'll get on my investment. So it started to get better when we realized only 15% of tariffs were actually getting through. But now we're starting to see a little bit of a tick down. It could just be a monthly fluctuation because of the summer. So it is something we need to keep an eye on going forward over the next couple months to hopefully make sure that we're getting back to that 12-month and 3-month average that we've seen over the course.
Yeah. And so again, that's just the change that we saw from July to August. Like you said, could just be a monthly fluctuation. We'll keep watching it. But as we saw that 66,000 job loss there in August, it makes sense when you're surveying these businesses. Where do you think you're going to be in 12 months? Do you think you're going to be having better performance or weaker? You can see why there'd be that concern for weaker performance coming out of that side.
Yep.
I'm going to have to say thank you so much for joining us today. Come back to our next video where we're going to talk about what was going on in the market of Georgina, as well as a few others that we have for you. Do not sleep on this information. It is so important if you are an agent out there to be equipped to have some of these conversations and to just understand what's going on in the market and what some of those forecasts may look like for you. It's important to be well versed in that. Homeowners, home buyers, and sellers, take a look at this data. If you need a deeper conversation about what your home may be worth in this market, Matt and I are consulting all the time on, is now the right time to sell. We often tell people to hold on if they can. Each bit of advice is tailored specifically to you and your needs, and we will give you the straight up in terms of what that looks like. And our goal is always to give you the information that you need to make the right decision for your family. So please stay tuned. Check out what we've got coming up next. Matt, anything you want to say on this one before we take off today?
Yeah, no, I thought you made a great point because, sometimes there's doom and gloom in the news media about the current state of the market, but the data tells us that it's pockets. If you're looking to potentially move from outside of Toronto into Toronto, your housing market is actually strong right now. If you're looking to move outside of Toronto and go to a certain destination, it depends on each pocket and how well it's doing. You might have a house that's actually really sought after right now, and you're moving to something that there's a lot of properties on the market. So it might be a great move for you. It just depends on your situation. And talking to Dylan or I, we'll be able to tell you straight up, is it the time for you now, or should you wait for potentially better data that come in to suggest that now's the time for you to make that move.
Yeah, awesome. Well said. All right, everybody. Thank you so much for joining us today. We look forward to seeing you again next time. Bye for now.